bond yields are rising in Japan, the US, and across Europe. You might have seen the headlines, but here's the hard truth: most people don't understand what it actually means. And that's dangerous. Because this isn't just a technical number on a financial chart. Rising bond yields can raise your mortgage rate. They can quietly erode your savings. They can shrink your investment returns, destabilize the housing market, hurt your retirement plan, even lead to mass layoffs. This is how financial stress starts, not with chaos, but with quiet cracks that most people ignore until it's too late. And the scariest part? It's happening fast. Globally. Silently. With massive consequences, but barely anyone is talking about it. In this video, I'll break down what's really going on with bond yields, in plain English, and more importantly, what it means for your money, your future, and how to protect both. Stay tuned.
The global bond shock. What's happening?
Let's begin with Japan, a country long known for its ultra-low interest rates. For decades, Japanese bond yields were stable, hovering near zero. Investors had come to expect predictability, safety, and minimal returns. But recently, that calm shattered. In just the past few months, Japanese yields have spiked dramatically. Why? Because the Bank of Japan began loosening its strict yield control policy, a move that caught global investors off guard and sparked a wave of selling. The result? Panic, uncertainty, and a ripple effect that didn't stop at Japan's borders. Now shift your focus to the United States. America's national debt has soared past 100% of GDP, a figure that would have sounded unthinkable not long ago. At the same time, the value of the US dollar is under mounting pressure. And the Treasury? It's issuing massive volumes of new bonds to cover growing deficits. But investors are no longer buying blindly. They're demanding higher yields, more return, to take on what they now see as riskier US debt. And this isn't isolated. It's not just Japan. Not just the US. From Europe to Australia, bond yields in developed economies have jumped sharply in just the last 30 days. Quietly, almost silently, the global bond market is undergoing a massive shock. Why does this matter so much? Because rising bond yields don't stay in the bond market. They spread. Higher yields mean higher interest rates for mortgages, credit cards, car loans, and business financing. Currencies begin to swing. Stock markets react, and often not in a good way. When yields rise this fast, this broadly, they act like stress fractures in the global economy. Banks feel it. Businesses feel it. Everyday people feel it. So the real question isn't simply, why are bond yields rising? The real question is, what happens next?
Why rising yields are so dangerous?
So why does a rising bond yield matter so much? First, let's talk about governments. When yields rise, it means the government has to pay more in interest on new debt. For countries like the US, Japan, and many in Europe, that's a massive problem. Trillions in outstanding debt now come with higher costs. The result? Ballooning budget deficits, higher taxes down the road, and less money for public services. In simple terms, more of your tax dollars go to paying interest, not improving your life. Second, investors are getting hit hard. Take Japan, for example. Many pension funds and insurance companies were heavily invested in long-term government bonds. When yields shot up, the value of those bonds fell sharply. Same story in the UK, where pension funds nearly collapsed in 2022 due to sudden moves in bond markets. This isn't just theory. Real money is being lost. Here's the key rule: when yields rise, bond prices fall, especially for long-duration bonds. If you bought a 30-year bond when rates were low, and now yields jump, your bond is worth much less on the market. And that's not just a problem for governments, it's a danger to banks, funds, and anyone holding debt-based assets. So rising yields don't just sit on a Bloomberg terminal. They ripple through the entire economy, and eventually, they reach your wallet.
The vicious cycle: debt, inflation, and confidence.
The vicious cycle we're witnessing right now isn't just about numbers or interest rates, it's about trust. And that trust, the foundation of modern finance, is slowly breaking down. For decades, U.S. government bonds were considered the safest assets on Earth. They were the bedrock of global finance, trusted by central banks and investors alike. But today, some of the biggest holders, countries like Japan and China, are quietly pulling out. Why? Because rising yields mean falling bond prices. And when bond prices drop, those who hold them risk massive losses. So they sell. Quietly, but steadily. But behind that sell-off is something deeper and more dangerous, a growing doubt about the strength and reliability of the US dollar itself. With America's deficit now projected to exceed 9% of GDP, a level typically seen only during wars or financial meltdowns, even major credit rating agencies like Moody's have begun sounding the alarm. And this is where the cycle begins. More debt forces the government to issue more bonds. The more bonds they issue, the more supply floods the market. That pushes bond prices down, and when prices fall, yields climb. But here's the twist: rising yields mean the government now has to pay more interest to borrow the same amount. So what do? They borrow even more. They print more money. And slowly, inflation creeps in. It's not a sudden collapse. It's what economists call a stealth default. You don't see a big crash on your screen. You just feel it at the grocery store, at the gas station, in your retirement account. Your money doesn't vanish, it just silently loses its power. And make no mistake, this is a hidden tax. You're not paying more upfront, but your purchasing power is being drained behind the scenes. This is how empires decline, not always through dramatic collapse, but through the slow erosion of confidence, value, and stability.
What this means for you.
So how does all of this affect you, the average person? First, rising bond yields push up interest rates across the board. That means mortgages, car loans, and credit card debt all become more expensive. If you were thinking of buying a home, you've probably noticed monthly payments are much higher now, even if the house price stays the same. But here's the twist: as borrowing becomes harder and more expensive, property prices could actually start to fall. Why? Because fewer buyers can afford today's rates. That means lower demand, and eventually, price drops. It doesn't stop there. Businesses are affected too. With higher borrowing costs, companies cut back on expansion, hiring slows down, and layoffs increase. This is how a credit crunch can lead to a recession. And it's not just the US. The UK, Japan, and even parts of Europe are all feeling the pressure from rising yields and declining investor confidence. This is becoming a global phenomenon. The danger is not just in the numbers, it's in the chain reaction. One crack in the system can lead to another. If you're feeling the pinch, from higher bills to a weaker job market, you're not alone. This isn't a glitch. It's a warning.
Can it be avoided?
So, can we avoid a financial crisis caused by rising bond yields? Yes, in theory. There are solutions. Governments can implement tax reforms, cut unnecessary spending, and reduce budget deficits. That would help restore confidence, lower borrowing costs, and stabilize the bond market. But here's the problem: most politicians don't want to make the hard choices. Cutting spending or raising taxes is unpopular. So they kick the can down the road until it's too late. We've seen this before. Take Greece, for example. A full-blown debt crisis nearly destroyed its economy. But through painful reforms and international pressure, they eventually stabilized. The US, UK, and other nations still have a chance, if they act now. Because here's the truth. Rising bond yields are not just economic headlines, they shape your financial future. They impact your savings, your investments, your job, and your ability to build wealth. Let me ask you, do you think governments are doing enough to fix this? And more importantly, how are you protecting your money from inflation and bond market risks? Let me know in the comments. If you found this valuable, please like, subscribe, and watch the next video on safe assets to hold in uncertain times. You'll want to hear this before the next wave hits.